Get the latest Zacks research, analysis, and rankings on exchange-traded funds in Exploring ETFs. Let's talk about hedging risk now using ETFs with our ETF strategist, Eric Dutram. So, Eric, when you say hedging risks using ETFs, what exactly does that mean for those who may not know?
Well, today we're going to take a look at a couple different ETFs that can kind of lower risk in the market, but still, stay invested in stocks. We don't really know what's going to happen with the whole debt ceiling issue. Stocks are up today, Wednesday, but this deal might fall through, and even if they do reach a deal, stocks might, run in these same set of problems a couple months from now as we inevitably reach another debt ceiling, just a couple months down the line. So it's important to look at some lower risk ETFs that could be better options for investors who still want to stay invested but don't want to take on the full level of risk.
Just lowering risk exposure to the market in general?
Definitely, but also still staying in the market and not kind of looking at some of the double inverse products that you have out there that are going to be high risk and could be beaten down if we do see a surge in the market and if a kind of a short-term deal is reached. Because if you look at like a triple leverage small cap fund, if you bet the wrong way here, you're going to lose like 9-10% in a day. So these products, probably, most likely nothing along those lines are going to happen to these. So it could be a good lower risk option for investors who still want to have similar exposure.
And as we sit here and talk ahead of the October 17th deadline, you're kind of assuming that there are still investors willing to take some form of risk.
Well, I think so, especially if you look at the markets this morning. The volatility levels are kind of declining here. But then again, this could all change depending on how Republicans and Democrats feel about the latest round of deals. But I do think some investors, do still want to be invested here, especially if a longer-term deal is achieved.
All right, so for those people, you've got some examples.
Yeah, the first one is the PowerShares S&P 500 Buy Right ETF, PBP. And this one takes a buy right strategy, which is an option strategy, where it writes call options on the S&P 500. So you're going to get some income from these options that are being written on the S&P 500 stocks, but you're also still going to be invested in all the S&P 500 companies. So you're going to get Apple, ExxonMobil, Google, all your typical big cap names. It is kind of an income strategy, so you do get a decent yield in this portfolio. Does kind of depend on how the market's trading and whatnot. But your upside is capped because of the covered call strategy. But in a down market, this ETF will definitely outperform S&P 500 only stocks. The one downside here is it is a little pricey, especially compared to the S&P 500. But this protection could come in handy if markets do tumble.
All right, so you actually have a product here that uses volatility.
That's true. It's another PowerShares fund, and this one is a downside risked ETF. And it follows the Vector Index, and this actually combines volatility, the S&P 500, and cash. And as volatility levels are rising in the marketplace, this product will actually allocate more to volatility, or like a VXX type product for ETF investors out there. And this is important because as volatility is rising, generally, investors are feeling a little more worried about the market, and stocks are actually sliding. So this can offer nice protection for investors. And it's a little cheaper than the other competitor out there, which is VQT. This one's about 40 basis points a year. That one's about 90, 85. So it's a cheaper choice in the space, and it could be a nice combination of volatility and regular S&P 500 exposure.
All right, and then the third option that you brought for us is actually a product that bets against stocks.
That's true.
What's up with that?
Well, this one's from AdvisorShares, and it focuses on a couple dozen stocks that have weak accounting fundamentals, low earnings quality. HDGE is the ticker symbol here. And the idea here is if there is a broad sell-off, these kind of stocks are going to be among the worst hit because they have the lowest earnings quality, and hopefully they are like kind of the weakest of the bunch. Obviously, the broad markets are rising. This is going to be kind of an underperformer, but if you kind of subscribe to the whole weak accounting metrics theory, these could still be better performers than most. So, this is kind of a higher risk choice in the space, but still kind of a hedging pick out there for investors who are a little worried about the market and kind of want some short exposure. This one is a little pricey thanks to the short interest expense, but it's one of the only options out there if you just want to short a couple of stocks and not just like a broad S&P 500 short like SH.
Okay. Do you own any of these?
I do not.
All right. Check out other ETF stories and commentary on our website, Zacks.com. Link to them right off the homepage with Eric. I'm Terry Ruffalo.